Yeah, I think now it has started. Right. So we have an important topic for the day, very critical for the financial year that we will be closing shortly. CARO 2020, which was originally supposed to be effective for the year, the previous year itself, but then was deferred a little bit. And certain changes that have been made to Schedule 3, which governs the format in which the financial statements of corporate entities will have to be prepared. Right? Now, broadly, the objective that is sought to be achieved by the Ministry of Corporate Affairs by way of bringing in these changes in CARO is to improve the governance in corporate entities, especially larger ones, right? Because over time, there have been instances where there have been large frauds that have been that taken place against the lenders, banks predominantly, right? You had Kingfisher at one point of time, and then you had the Nirav Modi scam, and then I think very recently you have the ABG shipyard issue that is going on, right? So there is a perspective that the governance in all of the corporate entities will have to improve significantly. And this is one step in that direction that the ministry is seeking to take. So if you look at a lot of the changes, they will be more in terms of whether the overall compliance done by the company, the way in which the company is operating is reasonably in line with what the law requires them to do, right? And most of the changes that have come up in Schedule 3 recently are consequential changes relating to the amendments that took place in CARO. What happened originally, it was CARO that was introduced, I think way back about 1.5 to 2 years back. But a lot of the questions in CARO were such that you could not find a direct answer to them from the disclosures made in the financial statements, because financials did not talk about some of those clauses. They did not contain any information on those clauses. So to bridge that gap, an amendment exercise was undertaken in Schedule 3 also, whereby for a lot of the clauses for which the auditor is required to report on in CARO, corresponding disclosures by the company, which will enable the auditor to take a decision, and also the users to understand our report better based on the disclosures in the financials were brought in place. Right? So now all of these changes are going to be effective for financial year 21-22. And please remember, in financial statements, we always disclose the corresponding periods figures, right? So when we talk about the financial year 21-22, we will also have to disclose figures for financial year 2021 in the corresponding figures column. And each of the changes that we are discussing, the corresponding periods disclosures also will have to be given, right? So we can't restrict ourselves to merely giving additional disclosures for 21-22 alone. We need to give the corresponding disclosures for the previous year also. So that is an added work that we will have to keep in mind, right? So this is just to give a broad overview on the background behind the amendments. Now moving on, what I will do for the day is I am focusing only on the clauses of CARO which have undergone changes, right? I am not going to touch upon the clauses of CARO where there are no changes. What I can probably do is I will share a separate list after the session. In fact, I prepared one, but it's in a very elementary manner as to which all clauses got changed, which clauses got deleted, which clauses got modified. So only the clauses that got modified are being covered, or new clauses that got inserted by way of CARO 2020 are getting covered. Clauses which have remained the same will not be covered during today's session. So those clauses you might want to take a look at it separately, especially the articles who have joined in the recent past. Some of you who have already handled audit engagements might know a bit of background on those clauses. The new ones can take a look at those clauses separately and get an understanding of those clauses. And similarly, Schedule 3 also, we are only going to cover up the changes. So what I will do for each clause of CARO where there have been changes, we will also cover how Schedule 3 has got amended to facilitate that additional point in CARO or the modified requirement in CARO. Right. This is basically how the session will go. And although it is only an internal session, I would prefer taking the questions at the end of the session, because a lot of times when we take questions in between, discussions start going on and then our timing gets stretched. So I want to keep this within that prescribed time of 1 o'clock, 1:30, because we started a little late. Maybe I can stretch it to 1:30. Right? Maybe we'll have the last 20 to 30 minutes for Q&A. I'll try and wrap up the presentation by 1 o'clock. Okay? All right. So in terms of the applicability of the new CARO, there is no change as compared to the CARO of 2016, right? But just to recap the applicability related matters, CARO is not applicable for banking and insurance companies because they are governed by a separate act, and the reporting methodology, the financials format, everything is different for those entities. And CARO is also not applicable for Section 8 companies, which are typically incorporated for not-for-profit purposes. And OPC and small companies, they are all very small entities where the governance risk, although there is not a material issue considering the volume of operations, and so those are also not brought into the purview of CARO 2020. And the last exclusion, thresholds remain the same. Any private limited company which should not be a subsidiary or holding company of a public company, right? So in case the private limited company has a subsidiary which is a public company, or it has a holding company which is a public company, it cannot fall under this exclusion. CARO will apply. If there is no such scenario, no such relationship, then we can look at the exclusion clause. There are 3 thresholds that will have to be fulfilled. All 3 have to be fulfilled. It is not that any one threshold you satisfy, you can escape from the requirement of CARO. All 3 have to be satisfied. So 2 limits have a threshold of 1 crore. One is paid up capital and reserves and surplus, which is typically a share capital, accumulated profit or loss, any securities premium, general reserve, all of that put together, it should not cross 1 crore. Similarly, borrowings from banks or financial institutions should not cross 1 crore at any point of time during the year. The only variance between these two is that the paid up capital and reserve and surplus figure, you can look at it at the balance sheet date. So when we look at financial year 21-22, as on 31/3/21-22 or 31/3/2022, if your net worth, paid up capital and reserves and surplus are 1 crore or lower, then you can look at exemption from CARO. But on the borrowings part, the 1 crore limit should not be crossed at any point of time during the year. So which means from 1/4/2021 till 31/3/22, on any day of the year, your borrowings from banks or financial institutions should not cross 1 crore, right? So this is one key difference that you need to keep in mind. Borrowings at any point of time during the year, paid up capital and reserves and surplus as at the balance sheet date, closing balance sheet. And the third threshold that is needs to be fulfilled to be exempt from CARO is that the total revenue of the company should not exceed 10 crores during the year. Right? Now here again, you might have a scenario where by chance the revenue crossed 10 crore on 30th of March. On 31st of March, there is a sales return because of which it has come down. Right? For the revenue number, you can rely on the revenue at the end of the year. If the end of the year revenue is less than 10 crores, then you can seek exemption from CARO. So all 3 of these thresholds, paid up capital and reserves and surplus 1 crore, borrowings 1 crore, total revenue 10 crores. If all 3 of these thresholds are fulfilled, and if you're a private company, not being a subsidiary or holding company of a public company, then CARO need not be applicable for that particular company. Right? This is the same as what was there in CARO 2016, but just for the benefit of all, to recap, I have just brought it into the slide. And one aspect which is slightly different from the previous CARO is that CARO 2020 requires, in the case of consolidated financial statements, to talk about whether there are any adverse remarks in any of the audit reports of the subsidiaries or joint ventures or associates of that particular holding company, right? That is the only change when it comes to the applicability part. CARO 2016 was never applicable for consolidated financials. In CARO 2020, the statutory auditor of the holding company, which is preparing consolidated financials, is required to talk about whether there are any adverse remarks in the audit reports or in the CARO reports of the subsidiaries and joint ventures, and draw reference to that in their CARO report in the consol financials. So that is one added requirement in the context of consolidated financial statements. Right. All right. So this is on the applicability part. Now moving on to the clauses where changes have happened. Right. Now most of you would be aware that AS 10, which originally dealt with fixed assets, got replaced by AS 10, which had the heading property, plant and equipment. Right. This was in line with the terminology used in the context of IFRS and Ind AS. And AS6, which used to deal with depreciation, got merged into the new AS10 on PPE. Right. So consequent to this, the wording in the CARO 2020 has been changed from fixed assets to PPE. Right. It's only a cosmetic change, just to bring into light that the terminology fixed assets is no longer being used. It is going to be PPE with respect to tangible assets. And CARO 2020 historically dealt with a question on whether the company is maintaining a fixed assets register containing quantity information, situation, location, and all that with respect to fixed assets. Now the scope has now been expanded to intangible assets also. In practice, always the FIR used to contain both tangible and intangible assets in all our clients. Now the scope has specifically been increased to cover both tangible fixed assets, which are PPE, and also intangible assets. So nothing great about the change. It is only a exercise to have clarity that even intangible assets need to be covered in the FIR and should have proper information on quantity. Of course, location doesn't really matter much unless you have geographical assets like trademarks or something of that sort. All right. Third matter, which is a little important. The question was already there, but they've brought in a format in which they want the disclosure to be done. So previously there was a question as to whether any immovable properties in the name held by the company reflected in their balance sheet. For those assets, whether title deeds are in the name of the company. If they are not in the name of the company, you are required to report on that fact and make some disclosures. But there was no specific format that was prescribed, and people used to write in their report depending on their facts and circumstances according to the case involved. Now for this, they have now brought in a specific format, and this format is also required to be included as part of your disclosures in the financials. So corresponding change is brought into Schedule 3 also. We'll cover the format in the next slide. So just remember that in cases where the title deeds of immovable properties held by the company are not in the name of the company, then it has to be specified separately in the CARO report and as well as Schedule 3 financials. Now this also covers any property taken on lease, immovable property taken on lease, for which lease deed is not held in the name of the company. So it is not just freehold immovable properties that are covered. Even for leasehold immovable properties, if the lease deed is not available in the name of the company, then we will have to report that in the CARO clause. Right. The next one, a specific question on whether there has been any revaluation of property, plant and equipment or intangible assets. Now, the CARO 2020, as you know, is applicable for a large set of companies. Some of them might apply AS and some of them might also apply Ind AS. Right? Now, in the context of AS 26, which deals with intangible assets, there is no revaluation model that is permitted. Right? Only for property, plant and equipment, you have both cost model as well as revaluation model. But for intangible assets, there is no revaluation model, but Ind AS permits revaluation for intangible assets also. And that is why the question covers both PP and intangible assets. But in the context of AS, you might have revaluation only for PPE revaluation for intangibles is not permitted by AS 26. All right. Now, in case there is any revaluation that has been undertaken, you will have to answer two questions. One is whether the revaluation has been done based on valuation done through a registered valuer. Now, this registered valuer is a particular professional, which was brought into the company law a few years back, where some persons, where they are eligible, they will have to appear for certain exams and get themselves registered as valuers under the Companies Act, after which they become entitled to undertake valuation of certain classes of assets. So if revaluation has been done, you need to talk about whether the revaluation was done based on the report of the registered valuer. And in case the revaluation amount is more than 10% of the carrying value of a particular class of assets, then the amount of the revaluation done is also required to be reported in the particular clause. So one, whether it is based on registered valuer's report. Two, if the revaluation amount is exceeding the carrying value of the class. By carrying value, I mean net block. If it is exceeding the carrying value by 10%, then you are also required to talk about the amount of the revaluation done for that particular class of assets. Last but not the least, also might not be very relevant in cases handled by us, but better to know so that in case any such instances come, you have it in mind. So you are also required to talk about whether there are any proceedings initiated against the company in respect of Benami property, right? And whether disclosures regarding those proceedings have been made appropriately in the financial statements. For this clause also, there is a certain reporting requirement that has been prescribed, which we will cover in the subsequent slides. So clause A and B, cosmetic changes, nothing critical. Clause C, format has come into place. The clause has remained. There is only a format that has come. Clause D and E are new items, which we will have to keep in mind. Revaluation and Benami property related proceedings. So now this is the template that has been prescribed both in Schedule 3 as well as in the context of the CARO clause as to how the disclosure needs to be done, right? You are only required to talk about those immovable properties where the title deed is not in the name of the company. So only the exceptions need to be reported, not all properties. And second important matter, any immovable properties which are held as inventories are not required to be covered into this clause. So real estate companies which hold immovable properties as inventories, in those cases, this will not apply. But if the same company has some immovable property as PPE, not as inventory, then for those assets, this particular CARO clause will apply. So nothing very different. They just ask you to disclose the gross carrying value in whose name the title deed is in. If it is not in the name of the company, whether it is, you will have to specify the name of the person in whose name the title deed is. And in the next column, you are required to report on whether they are related, whether that particular person in whose name the title deed is held is a promoter or director or relative of a promoter or director or an employee of the promoter or director and all that, right? So in case there is a relationship with the person in whose name the title deed is, that needs to be disclosed. And the date from which the property has been held by the company. And the reason you are required to talk about why, although the asset is being reflected in the balance sheet of the company, the title deed is still not being held in the name of the company. Right? Now, reason could vary depending on the facts of the case. One common scenario where we face this is sometimes what happens, companies go in for a merger, right? So there will not be a typical transfer or sale deed that gets executed for a transfer of movable property. It's only the court order that acts as the instrument by which transfer happens, and only the court order will get registered, right? So there will not be any sale deed per se in the name of the company into which the assets move into after merger or demerger. So in those scenarios, only the court order will get registered and stamp duty will get paid, but there will not be a specific sale deed or title deed in the name of the company. So those are genuine reasons which we can talk about in that last column. And in case there is some dispute in respect of that property, then details of the dispute is also required to be disclosed in the reason column, right? Sometimes what might happen for some issue in respect of registration, they might have done the registration in somebody else's name, but money might have gone in from the company as a temporary measure. Some dispute might have arisen after that, because of which transfer to the company is pending and all that. So depending on the facts, in case there is a dispute, that also needs to be disclosed. So in case title deed is not in the name of the company and it appears that the transaction, the reason for the transaction is not known, then we might have to discuss with the management to understand what the background behind the transaction is and whether there are any disputes that are going on. Same disclosure is required to be given in Schedule 3 financials as well as the CARO clause, right? All right, Benami properties. So like I said, in case any proceedings have been initiated against the company or they are pending against the company for holding any Benami property, then these informations need to be given. Now, what is Benami property? For basic understanding, most of you might already know because it's a colloquial term that is used. When property is acquired by X, but the money for acquiring that property has come from Y, right? So essentially what happens, X is holding the property in his name, but he is holding the property, he acquired the property using money provided by Y, and he typically holds it for the benefit of Y or somebody else that Y might decide upon, right? So these are the assets which are generally classified as Benami property. There are certain exceptions within family members and all that. So I'm not getting into too much of complications for now, because these are very rare scenarios. I don't want to spend too much time on this. So basic understanding on Benami property, when funding has come from one person, but the property that has been acquired using those funds is getting registered in some other person's name, right? So that is the general case of a Benami property. Now, in case there are any proceedings initiated under the prohibition of Benami Transactions Act, then disclosure needs to be given in the financials about the details of that property, when it was acquired, the amount involved in the acquisition of that property, who are the beneficiaries of that property, right? Who is this particular property benefiting, for whose benefit it has been registered in the company's name. And if the property is being reflected in the books of the company, in some rare cases, proceedings might be initiated, but that property might not be there in the books of the company itself, right? So in case the property is in the books of the company, then a reference to where it has been disclosed in the balance sheet. If it is not in books, then why it is not in the books, in whose property it is registered and all that. And in case the company is not holding Benami property, but it sold a property which has now been treated as Benami property because the buyer has acquired it as a Benami holder, or it has assisted or abetted in a Benami property transaction. In those scenarios also disclosures need to be given. So although the proceeding might not be directly against the property in the name of the company, in case the company has acted as a transferor or it has abetted any such transactions, in those case scenarios also disclosures are required to be given. And last one, the nature of the proceedings. What is the present status of the proceedings? How the proceedings are expected to pan out in the view of the company and all that, right? And typically, there are three stages that are perceived in the prohibition of Benami Transactions Act. One is the attachment of the property, after which there will be an adjudication that happens. And if it is adjudicated that the property is originally, it is in the nature of a Benami property, then the government has the right to confiscate that property, right? So at what stage the proceeding is in, and what the possible outcome of the proceeding will be, is also required to be disclosed by the company, if at all there are any proceedings initiated or pending under the Benami Transactions Act. So this broadly covers the changes with respect to the first clause dealing with property, plant and equipment and intangible assets. So very relevant one is going to be this table, because sometimes you might have such scenarios at some of the companies. Benami properties related matters and revaluation might not be very frequent, but keep it in mind so that when any such instances come, you can factor these in reporting. All right, few other matters, smaller ones relating to PP and intangibles. Like I said, Even in Schedule 3, you are required to talk about. So typically we have a note on PPE, right? We talk about the opening gross block, how much of additions has happened during the year, what is the deletion, closing, similarly accumulated depreciation and all that. So in that particular table, in case there is a revaluation of 10% or more of the net carrying value of a particular class of assets, then the revaluation amount is required to be separately disclosed as a individual line item rather than clubbing it against something like an adjustments row or something of that sort. In case revaluation is more than 10% of the net block, then it is required to be shown as a separate line item. This is on the fixed note on PPE that is contained in Schedule 3 financials. And similar matter on the whether revaluation has been done through a registered valuer. And third one also cosmetic change because of the rewording of the AS10. Now in Schedule 3 financials, face of the balance sheet, intangible assets have also got added. The change to property, plant and equipment happened, I think 1 or 2 years back. Previously, it used to be tangible fixed assets. So the present heading is property, plant and equipment and intangible assets. And below that, you have 4 items, which is property, plant and equipment, intangible assets, capital work in progress, and intangibles under development, right? So those are the 4 subheadings that will now be reported on the face of the balance sheet under PPE and intangible assets. Now, this is an additional disclosure requirement that is being sought with respect to capital work in progress and intangible assets that are under development, right? So these are all, there are quite a few aging tables that will come up as we go by, right? So these aging tables to a certain extent give the user of the financial statement as to how the company is performing in terms of executing its projects, right? Whether they are in line with their original plan with respect to both the timeline that was originally planned as well as the cost budget that was originally planned, or if there is a delay, what is happening, why is the delay there and all that, right? And it also gives an idea to the lenders of the company, because typically project loans taken for capex, there will be a proposal that gets submitted to the lender in terms of how much they are expected to incur for that particular project, how much of that is going to be through bank loan, when they expect to initiate commence the production from that particular project and all that. So these disclosures will help the lender also understand where the company is, whether the project for which the funding was given is proceeding in line with their expectations, or there are some delays which need to be monitored and all that, right? Now here, the first table requires disclosure of aging. For how long the capital work in progress or the intangible under development has been sitting on the balance sheet, right? So let's say you have incurred, for example, capex cost on a effluent treatment plant sometime in 2020, right? Say September of 2020, but it is still not yet capitalized, right? So when we look at the balance sheet as at 31/3/2022, that is going to fall in the 1 to 2 year bucket. So you need to look at the aging based on the balance sheet date. Similarly, for the previous year's capital WIP, you will have to look at the aging based on the previous year's balance sheet date, which is 31/3/2021. Like I said at the beginning of the presentation, disclosures have to be given for both the closing CWIP of the current year as well as the closing CWIP of the previous year, the corresponding figures, right? So depending on which year the costs were incurred, we will have to classify it in the respective aging buckets in this particular table. And you are also required to segregate between the projects which are in progress or any projects which are temporarily suspended. Sometimes for regulatory reasons, there might be a suspension that is given. For example, pollution norms are not complied, so the government might say you cannot go ahead with the project unless you fulfill certain conditions which you violated and all that. So those sort of scenarios, sometimes there might be a temporary suspension. Could be regulatory, could be administrative, whatever the reason might be. In case there is a temporary suspension, that amount needs to be disclosed separately. Projects which are in progress without any suspension as of now will have to be disclosed in a separate table. The second table is where you talk about the overrun in time and cost. So in case there is any project where your original cost was, for example, 20 crores, but you've already overshot that budget, or you expect to overshoot that budget, and similarly timeline was say 1 year within which it has to be completed, but you've already crossed 1.5 years, 2 years and all that, then you are required to talk about those projects where there are overruns separately. And even in those, you just have to specify what is the project that is being talked about and when it is expected to be completed, whether it is going to get completed within the next 1 year or after 1 to 2 years or in 2 to 3 years or more than 3 years, right? So the second table is not about aging, it is about the future completion estimation of the company as to when that project which has already suffered an overrun is going to get completed, whether it will be in the next 1 year, 1 to 2 years and all that. Right? So for any companies that are into putting in money into capex significantly, this disclosure becomes critical, and we'll have to be careful in classifying the amounts in the appropriate tables. All right. Yeah, so I think that's pretty much the disclosure requirement in Schedule 3 and the CARO clauses on PPA and intangibles. All right. My voice is audible now, guys, because I am connected over mobile internet. Okay. Yeah.
Yes, sir.
All right. Now moving on to the next clause on inventories. Even for inventories, previously there was a clause. The same clause has got modified and a few additional requirements have been brought in. Right. In the existing CARO, we were required to talk about whether the physical verification exercise that is being done by the management is reasonable considering the volume of the company and all that. Now the question is slightly reworded to say that the auditor is required to report on the appropriateness of the coverage and procedure also. So in addition to looking at how frequently the management is doing physical verification, what sort of procedures are being followed, we will also have to talk about the coverage. How much of the inventory is getting covered over a period of time? How much time is being taken by the company to cover the entire inventory? Whether in a cycle, say 6 months, over a period of 6 months, they ensure that all items are getting covered. All right. So we'll have to look at what policy is being followed by the company to comment on the appropriateness of the coverage and procedure of physical verification. Right. So there is a slightly modified requirement compared to the existing CARO. Second question, which is already there. In case there are material discrepancies, you are required to talk about whether the corresponding adjustments or impact in books have been given, whether they have been properly dealt with. Now the clause has become more specific to say, in case there are discrepancies of 10% or more in the aggregate for each class of inventory would typically be raw materials, work in progress, finished goods and all that. So any particular class of inventory in which the discrepancy is 10% or more, you need to look into and report on whether the discrepancies have been properly dealt with in the books. So what was material previously has now been specifically defined as 10% or more of that particular class of inventory, right? Last point, very important, and in which some of you who have attended bank audit also would have noticed, which usually companies play around with. So in case a particular company is enjoying working capital limits in excess of 5 crores, when we talk about working capital limits here, it is both fund-based and non-fund-based, right? Fund-based is for the benefit of those who might not have joined the bank audit engagement. So fund-based limits are cases where you borrow money from the bank directly, right? You get a cash credit, you get an overdraft, right? These sort of limits or packing credit loans, these are all fund-based limits. Non-fund based limits are scenarios where you don't borrow money from the bank directly, but you use one or two of their facilities to get some of your business activities done. For example, letter of credit issued by the banker in favor of your supplier to facilitate you to purchase materials from the supplier, or a bank guarantee issued by the banker in favor of, let's say, a government entity for a tender or contract that you have taken from that government entity, right? In these sort of arrangements like letter of credits and bank guarantees, the bank does not lend money to you, but it gives a guarantee to that counterparty saying that if your company does not pay, I will pay. Similarly, it gives a guarantee to the supplier saying that if the company does not make the payment for the materials purchased, the bank will fulfill the amount that needs to be paid. So those are non-fund based limits. So any company which enjoys working capital limits, which is the aggregate of both fund based and non-fund based, in excess of 5 crores, this clause will apply. Right? And also the limits have to be based on the current assets being held as security. Right? Sometimes what companies will do, they might not hypothecate their current assets as security. They might mortgage some immovable property as security, and based on that, they may take a working capital limit. Right? So in those sort of scenarios, this clause might not apply. When the working capital is being given on the basis of the current assets, which is typically receivables and stock, inventory and trade receivables are the securities that are commonly given as security for working capital, the assets that are commonly given as security for working capital limit. So in those scenarios, this clause becomes applicable. Now, what are you required to do if this clause becomes applicable? You are required to talk about whether the quarterly statements that have been filed with the banker. So typically companies, any lender who is enjoying working capital facility on the basis of current assets is required to submit stock and receivable statements to the lender usually on a monthly basis, right? Reporting requirement is only on quarterly basis. We don't have to bother about the intermittent months. So we only need to bother about stock and receivable statements for 30th June, 30th September, 31st December, and 31st of March. Right? These are the 4 months that we need to bother about. We don't have to talk about the other months. So we can stick to that requirement. So for those 4 months, whether there are any variances between what stock and receivables have been reported to the lender vis-a-vis what is reflected in the books of account of the company. Now, this is going to be challenging primarily because a lot of entities do not maintain their inventories as part of their accounting package. Receivables might not be a major challenge because their accounting package will have that information. You can extract reports, compare it with what is there. Where the company does not have a integrated package, then reporting on stocks become a little difficult. So in those scenarios, you might have to look at what other software is being used by the company for stock, extract reports from there. First of all, we need to have comfort on whether the recording of entries in that other software is also reasonably correct and matching with books. If we have that comfort, then we will have to look at extracting stock statements as at those particular month ends and compare it with what has been submitted to the bank. In case records are being maintained manually, all the more difficult and challenging. Depending on the situation involved, we might have to look at what sort of procedures we need to perform on reporting on this clause. In a worst case scenario where sufficient information is not possible, we might have to even look at qualifying this clause, especially in the context of inventories. With respect to receivables, most likely data will be available for comparison. For inventories, we'll have to spend some additional time, especially where the inventory records are not integrated with the accounting package. Right? Now, what is required to be disclosed is this. This is a Schedule 3 requirement. In CARO also, you can consider following a similar. In fact, this table is not prescribed in Schedule 3. This particular table is recommended by our institute, which is available in the guidance note on Schedule 3. Right? All right. So the corresponding disclosure requirement for this clause in Schedule 3 is this. Where the company has borrowings with current assets as security, it needs to talk about whether quarterly returns or statements of current assets are in agreement with the books of accounts. In case there are differences which are material, then they will have to disclose the fact and also provide a summary of reconciliation for those differences. Now remember, the CARO clause is applicable only for those entities with working capital limits in excess of 5 crores. For the Schedule 3 requirement, if my memory serves me right, there is no threshold limit. So all companies which enjoy working capital facilities on the basis of current assets given as security will have to make this disclosure, which means we cannot restrict our verification only to companies which exceeds, with limits of more than 5 crores. Even for companies where CARO itself is not applicable, this disclosure is applicable, and so we will have to ensure that at least for those 4 quarters, we cross-check what is there in the books versus what is disclosed in the financials, or other, what is reported to the bank, and ensure that the company does the disclosure properly in the financial statements. In case there are differences, but the company is not disclosing that, then we might have to look at talking about it in our audit report. All right. So the exercise of comparison need not be restricted only to companies to which CARO is applicable, or CARO applicable and working capital exceeding 5 crores, nothing of that sort. This exercise has to be done for all companies where working capital facilities are there, with current assets being given as securities. All right. So this is on the inventory related matter and its connected impact where borrowings are availed based on those inventories. Right. Moving on to the next clause. This again was an existing clause which has been modified. Previously, this clause only used to talk about the loans that were given by a particular company, right? Now they have expanded the scope to investments made by the company and also any guarantees or securities given by the company. There is a slight expansion of scope. The context remains the same though. And you are also required to specifically disclose any transactions that have been undertaken of this nature: loans, investments, guarantees, and securities. You need to segregate them between those transactions which were undertaken with subsidiaries, joint ventures, and associates, and those transactions which were undertaken with other parties, unrelated entities. Right? You need to give a segregation, and this second disclosure is only with respect to transactions during the year. It is not a cumulative figure. You are only required to talk about how much is the transaction during there, how much investment was made, how much loan was given, how much guarantee was given. All right. The aggregate amount during the year and the closing outstanding balance is what is required to be disclosed. Third clause, which was already there in the context of loans given, it was there. The auditor is required to report on whether the terms in which the loans were given or investments were made or guarantees and securities were given are prejudicial to the company's interest. Right? Now, how do you find out whether it is prejudicial? This is a tricky question. Right? To give you an example, when you lend money to a certain person, generally you would expect a particular interest rate if it is unsecured in nature, or if there are securities that are being granted, then you might consider a lower interest rate. And similarly, you will also have certain reasonable repayment terms in mind, because the loan cannot continue forever with interest only being serviced, right? So depending on the facts of the case, purpose for which the loan is given, the first aspect that you also need to look at whether the purpose is genuine, right? Whether there is a requirement for the company to grant that loan. What is the financial position of the counterparty? Why are they seeking the loan or seeking the investment? Right? Whether the transaction appears genuine. And then you might have to look at the terms on which those transactions have been undertaken. For example, if guarantees are given, then whether at least some commission is being charged for the guarantee given, because the company's properties will be given as security to the lenders to make a guarantee. Similarly, when it comes to investments, the pricing of the investment. It cannot be a case wherein a company subscribes to shares at a very high premium, although the counterparty does not demand such a high premium, right? So the pricing also needs to be looked into to understand whether there is a reasonableness in the transaction. So if the transaction per se is reasonable given the facts involved in that particular case, then one can take a call that the transaction is not prejudicial to the company's interest. And this prejudicial part becomes very critical when, for instance, the company that we are auditing itself is not in a very good financial position. But despite that, they go and make some additional investments, they go and give some loans. All right, those sort of scenarios are definitely going to be prejudicial to the company's interest because the company is already not doing well financially. And in such a case, if they divert their funds for other purposes, then becomes difficult for them to continue functioning in a smooth manner, right? So this is one clause that we need to report on. An existing clause which talked only about loans given, now you have investments, guarantees, and securities also coming into the scope of that clause. Fourth clause, which is already there, whether repayment terms have been prescribed for loans given and whether there are any overdue amounts. There is an existing clause that is continuing, nothing new about it. The fifth and sixth clause are new ones. Sometimes what companies will do, there used to be there's a good term for this. Evergreening is what it is called in the banking terminology, right? So what they will do, if one loan is falling due, another loan will be granted, which will be used for settling the old loan which is falling due, right? So you keep granting fresh loans to repay existing loans and it keeps going on. It is colloquially called evergreening. So you're required to talk about whether any extensions have been granted for existing loans, any renewals have been granted, or any instance of fresh loans being granted for the sake of clearing an existing overdue loan. Okay, if any of these instances are noticed, we are required to disclose about it in the particular CARO clause, the aggregate amount and the percentage to the total loans granted during the year. Similarly, in case any loans are given as repayable on demand or without any repayment terms, then we are required to talk about the quantum of such loans. And we are also required to disclose whether any of those loans have been given to promoters and related parties. Okay. So clause D, the subclauses D, the E and F here appearing in the slide are relevant only in the context of loans given. All right. A, B, and C are applicable for all four: loans, investments, guarantees, and securities. D, E, and F are specific to loans given. They will not cover investments or guarantees and securities. Now for clause F, which is in relation to loans given as repayable on demand or without specific terms of repayment, there is also a Schedule 3 requirement on disclosure, which is being replicated here, right? So you'll have to classify. In fact, I think this is only in the context of loans being given to promoters, directors, KMPs, and related parties as far as Schedule 3 is concerned. So you need to break them into two categories. One is those loans which are repayable on demand, and those loans where the terms of repayment are not clearly specified, right? So you need to classify it into two subheads, and under each of those subheads, you need to disclose a table for promoters. And you don't have to specify party wise; it is only at a category level. So how much is outstanding from promoters, how much is outstanding from directors, how much in the current period, how much in the previous period, and all that, right? And related parties in the context of this disclosure is the same definition that is available in the Companies Act 2013. And of course, more of clarificatory in nature. What is required to be disclosed under amount outstanding should be the gross amount. When we say gross amount, it is not original loan given. It is outstanding loan amount, but without reducing any write-off or provisions, right? Sometimes what might happen, because recovery might be doubtful, the company might make a provision for say 10%, 20%, or 30% of the loan. And the net amount alone will get disclosed in the schedule. Of course, we will show the gross amount, show the provision as a reduction, and then show the net figure. But for this disclosure, it is only the gross amount that is required to be disclosed. Provisions or write-offs should not be reduced. And in case there are any loans which have been granted during the year and they have also got repaid during the year, which means there is no outstanding balance at the balance sheet date, then that number need not come either in the previous period or current period. No specific disclosure would be warranted for those transactions where the loans were given during the year and they were also repaid before the end of the year itself. right? So this is the disclosure requirement in Schedule 3 corresponding to this particular last subclause with respect to loans given. Right? Moving on, this is a new clause that has come into CARO, of course, with corresponding implication in Schedule 3 also. So, in case it is come to the notice that there is a transaction that is not recorded in the books of the company, but it has been surrendered or disclosed as income voluntarily, right? So, in case a company is voluntarily offering, excuse me, some transaction as part of their income, but which has not been recorded in their books previously, then that needs to be talked about in CARO, and also there is a Schedule 3 disclosure. All right. Now, what is meant by the term voluntarily? There is detailed guidance available in our institute guidance note. Just to quickly summarize, this term will cover only those transactions which the company has offered as income without any coercion. Right? Something that they are doing out of their own interest or own choice. All right. It should not be something that is forced upon them by the income tax department or its officials, or something where just for the litigation to get over, they decided that okay, let's pay some tax and close the matter. All right. Those sort of scenarios are not covered here. Only in scenarios where the company has done some transaction which has not been reflected in the books, and they have themselves voluntarily disclosed it as income with the department during the particular year, it needs to be talked about and brought within the scope of this class. Right? And for any such transactions, you are also required to talk about whether the income and the related assets which were previously not recorded, because obviously if they have not disclosed it to the tax authorities, it usually doesn't get reflected in the books also. It is outside the books, right? So in those scenarios, whether those incomes and related assets, at least in the year in which they are voluntarily offering, have they been recorded and brought into the P&L and balance sheet of the company is something that you need to talk about. Right? Now, Schedule 3 also requires the same disclosure, right? But the only variance that I noticed is that now some of you would remember that it was CARO 2020 that came first, and the corresponding changes in Schedule 3 happened a little bit later. All right. So when we look at the requirement in Schedule 3, the same disclosures are being covered. But one exception that I noticed was that in case there are any disclosures that were made under a scheme for which immunity is granted, right? Typically, a recent example is your income declaration scheme. Just before demonetization happened in 2016, government came up with an income declaration scheme saying, in case you have any past undisclosed income, past undisclosed assets, you can offer it in the scheme, pay 45% tax and regularize it. We will not initiate any penal or prosecution proceedings against you, right? So in case there are any disclosures that were made under such schemes where immunity is granted, then Schedule 3 does not warrant including the transaction for disclosure under this particular head of undisclosed income. But in CARO, there is no such exception, right? Probably because this was not thought out when CARO was amended. It came to the mind of the regulators when subsequently Schedule 3 got amended. But as it stands now, even disclosures under such schemes have to be talked about in CARO unless a corresponding change is being made in CARO in the near future. Right? Here again, there is a recommended template that is prescribed by the institute. The year to which the matter pertains, the section under which the income has been offered, how much has the amount that has been disclosed in the tax return when it is offered voluntarily, what is the nature of the transaction, how much of it is treated as income, what is the status of assessment for that particular matter, whether the transaction has now been recorded in books because previously it would have not got recorded, and the year in which it is recorded. In some rare scenarios, it might be a case where the transaction is recorded in books for income tax, it was not considered. Okay. So in those scenarios, the transaction is already recorded. You might have to say that the financial year in which it was recorded is a past year.
So this is in the context of requirements with respect to undisclosed income. Again, not a very common scenario, but just keep this in mind so that in case you come across facts relevant in this clause, you might have to apply these requirements. Are we now 7:20? Okay, so maybe another 10 minutes. I'll finish off borrowings. It's only about 3-4 slides, and then we can have a break and then join back. All right. Moving on to the requirement on borrowings. This clause also has undergone a modification. In fact, it has been segregated into 2 separate clauses with some modifications also. The first requirement, this was already there, but I think a table is also being brought in terms of improving the disclosure. So in case there is any default in repayment of loans or borrowings or in the payment of interest, so any default in principal repayment or in interest, you are required to talk about the period and amount of default. And please note, this is not something that has to be outstanding at the year end. Even defaults that happened during the year but got subsequently regularized before the year end will also have to be disclosed in this table. All right. So you need to talk about what is the nature of the borrowing. It also covers debenture related transactions. Who is the person from whom the money was borrowed? Name of the lender. How much was not serviced on the due date, whether it is principal or interest, amount involved, and whether it is in the nature of principal or interest. What is the present status, whether it continues to remain unpaid, or if it has already been paid, how much is the number of days of delay after which it has been paid, and any corresponding remarks. So we need to have complete control on the servicing of borrowings during the year. If it is working capital interest, servicing of interest, working capital facilities. If it has term loans, then servicing of principal and interest on the respective due dates, for us to be given appropriate answer on this particular clause. All right. Most of you would be aware that we have a separate working paper template for borrowings. So if you complete that in a proper fashion, that itself will give you comfort on finding out whether the company has done the repayment properly. Right. Second clause, the auditor is required to report on whether the company hasn't been declared as a willful defaulter by any bank or financial institution or any other lender. Right. Now, what is meant by willful defaulter? Willful defaulter is typically someone who either, although capable of servicing the loan, does not service the loan willfully, or because of diversion of funds that were borrowed for purposes other than for which it was obtained, is now not in a position to service the loan. Right? There is a separate RBI master circular that deals with willful defaulters. You can look at that for more information, but broad understanding on willful defaulter is somebody, though capable of repaying, does not repay, or diverts the loan funds for purposes other than for which it was meant, resulting in a scenario where they are unable to repay the loan. All right. Now, how do you find out whether the company is a defaulter? I've covered that in a separate slide based on guidance issued by ICAI as well. So there are a few credit rating agencies, credit monitoring agencies, which publish list of willful defaulters as reported by banks on a periodic basis. I will talk more about it in the next slide. All right. So it's not a very challenging job. You just have to look at those lists and identify whether the company is forming part of any of those lists. All right. Third point, whether the term loans availed by the company have been applied properly for the purpose for which it was obtained. In case there is any diversion, then how much of money got diverted and what is the purpose for which it got diverted, right? Now, for this particular class, in scenarios where banks disburse the money directly to the supplier of the borrower, it becomes very easy for us to say that the application is done properly. So a lot of times what banks will do, let's say the company is taking a term loan of 5 crores to purchase a machinery of say 6.5 crores, right? So what the bank will do, they will ask the company to pay 1.5 crores to the supplier. They will transfer 5 crores directly to the supplier. The supplier receives 6.5 crores and they will sell the machine to the company. So in those sets of facts, it is very easy to say that the term loan has been applied for the purpose for which it was obtained, because the money never came to the company. It went directly to the supplier of that particular capital asset. But in cases where the disbursement comes to the company and then the money is used by the company, things might get a little tricky. So in those scenarios, you might have to look at what was the purpose for which the term loan was originally sanctioned and whether the money has gone for those purposes. In practice, sometimes the term loan will get credited to the CC account. It might sit in the CC account for a few days and then it might be used for the purpose for which it was originally availed. Those sort of minor delays in utilization is not a major challenge. In case the fund gets used for something else and it never comes back, it never goes for the original purpose, then it is a cause of concern which will have to be reported suitably in the particular clause on CARO, right? So any new term loans that have been availed by the company during there, you will have to be careful in looking at whether application is done properly. Now the fourth point, this was in fact possibly maybe Shankar and Satyan might be aware, Shabnaka I think might be aware. This was a clause that was originally there in CARO in the 2003 version, if my memory serves me right. But after the new Companies Act came in, CARO got changed, and after that, I think this clause has been removed, but now it has been reintroduced again. The auditor is required to talk about whether any funds that were raised on short-term basis have been utilized for long-term purposes, right? Now, this is a basic financial principle that when you borrow funds on a short-term basis, you should also utilize it only for short-term purposes, because all short-term borrowings typically are repayable on demand, all right, or there is a very limited credit period. So when you're required to pay money to a particular person within the next few days or few months, if you put that money in some asset which will not come back to you for the next 1 year, 2 years, or 3 years, when the person from whom you took the money on short-term basis asks for repayment, you will not have a corresponding short-term asset which you can liquidate and use it for repayment of the short-term borrowing, right? So the general financial principle that needs to be kept in mind is that funds used on short-term basis have to be used only for acquiring short-term assets, current assets. Only those funds which are used for long-term purposes, availed for long-term purposes, raised on long-term purpose basis, typically your share capital, your term loans, right? Long-term debentures, okay, these sort of fundraisers. So these funds raised for long-term basis, they can be utilized for both long-term and short-term. Because if it is used for short-term, it's very good because you have the money in hand, easy. But since it is raised on long-term basis, it can also be used for long-term purposes, right? So this is the basic premise. Now you are required to talk about whether the company has followed a practice of utilizing funds which were raised on short-term basis for long-term purposes. So a basic comparison of current liabilities in the balance sheet vis-a-vis current assets will itself give you an idea of whether such crisscross or wrongful utilization of short-term funds have been undertaken by the company, right? Now, two matters that you have to keep in mind. First, in the financials, we follow a practice of disclosing the current portion of long-term borrowings under current liabilities, all right? In fact, there is a slight change in the disclosure that I think will come in one of the subsequent slides. So although the original borrowing is of a long term, the installments of principal that are required to be repaid within the next 12 months, we don't disclose it as part of non-current liability. It comes into the current liability component, right? But the original nature of that loan is a long-term loan. So when we undertake this comparison exercise, the current maturities of long-term debt have to be excluded to do this comparison. So it is not fund raised on short-term basis, long-term. Sorry, it is not fund raised on short-term basis. It is actually fund raised on long-term basis for a term loan. All right. So that number has to be excluded for doing this comparison. That is point number one that you need to remember. Second aspect, in some scenarios, when a particular company incurs losses over a period of time and those losses are not being funded by the promoters by way of additional capital infusion, there will most likely be a scenario where the company starts eroding its current assets, because of which its current liabilities will start overshooting the current assets. All right. These scenarios might not necessarily be a case of conscious utilization of short-term funds for long-term purpose. It is the end result of the company incurring losses over a period of time which have not been adequately funded by the promoters. So in those scenarios, we can talk about the fact that there is such a utilization, but also bring to light that the reason for that, such a scenario is because of the history of losses of the company, right? So rather than not saying that it is not being used, because when somebody looks at the balance sheet per se, they will have a feeling that funds raised on short-term basis have been utilized for long-term purposes. So we can bring that fact into light, but also disclose that the reason for such a situation being present is the history of losses which have not been adequately funded by the promoters of the company, right? So two matters to keep in mind: current maturities of long-term borrowings need to be excluded. In case of historical losses, suitable comment may need to be included. Then clause E is a new one. It was never there in any old CARO also. You are required to talk about the details of funds which have been taken from somebody else for meeting obligations of subsidiaries or associates or JVs. All right. So in case any of your subsidiaries or associates are unable to meet their obligations, and in order to support those obligations, you borrow money from somebody. All right. In those specific scenarios, you are required to comment on this clause. If there are no subsidiaries or associates, or there are no obligations for those entities which are being met by the parent entity by borrowing, then this clause does not become applicable. Last subclause: any loans that have been raised by pledging securities held in the subsidiary or associate or JV. All right. So these are all items which will get disclosed in the investment schedule of the financial statements. So in case any of these shares held in the subsidiaries or associates or JVs are pledged as securities and loans have been availed based on that, you are required to talk about it. And in case there is any default and repayment loan of those loans also, a specific comment is warranted. Right? So this is on the clause with respect to borrowings. So I think clause D has been brought back, which is a little important. Clause C has already been there. It is only additional disclosure on the amount that has got diverted and the purpose for which it has gone. Clause A was also there, but I think the template was not prescribed, which is now prescribed in a particular manner. Now, in the next slide, we'll talk about the willful defaulter and disclosure in Schedule 3 and the term loan application in Schedule 3. Right. So now here, in case the company has been declared as a willful defaulter, you are required to disclose in Schedule 3 the date on which such declaration was done, the date on which the company was declared as a willful defaulter, and the details of defaults. How much is the loan amount that has been defaulted? What is the amount and the nature of the default? Right. Now, like I said, there are 4 credit rating agencies which periodically publish list of willful defaulters. I have specified the links from where those reports can be extracted. So when you undertake the audit, you can look at downloading the latest list from these sites and ensure that the company that is being audited does not fall in any of those lists. Right? 2-3 key matters. Even if the company was declared as a willful defaulter for 1 day of the year, then it needs to be disclosed. All right. Doesn't matter if it was subsequently rectified. Even if there is one instance of declaration of willful defaulter which has been there only for 1 day, it has to be disclosed. And even in cases, sometimes what will happen, the declaration as willful defaulter might be done after the balance sheet date. Up to balance sheet date, they might have serviced their dues. Post balance sheet date, they might have not serviced and they might have got declared as willful defaulter. Even those scenarios might have to be considered, and it is ideal to bring those events also as part of the disclosure of the financial statements. Right? Next one on charges. This is only on Schedule 3. There is no requirement to report on CARO. In case there is any delay in registration of charges or satisfaction of charges with the ROC beyond the statutory period, then the details and reasons for the same have to be specifically disclosed. Usually there is a 30-day time window within which charge creation, modification have to be filed, and satisfaction also. In case there is any delay, then you are required to talk about the nature of the charge, who was the registrar involved, when the registration should have been completed, and what is the reason for the delay. And like I said in the willful defaulter context also, it is ideal for us to cover where registration is completed, or in fact this is more basically default during the year but rectified by the end of the year. So need not restrict yourself only to those pending charge creation, satisfaction or modification at the end of the year. Even if during the year there was some delayed filing, that can also be disclosed as part of this particular table on charges, right? So any new loans, closure of an existing loan, increase in limits, changes in particulars of security. If any of these events have occurred, then you will have to look at whether the corresponding impact in charges has been done by the company on a timely basis. If not, needs to be disclosed here. A few other matters. There is a specific point in Schedule 3 where the company is required to talk about whether the borrowings taken from banks and financials have been used for the specified purpose only. That is the purpose for which they were originally obtained, as agreed with the lenders. If not, then where they have been used. Sometimes companies tend to utilize CC limits for acquiring capital assets and all that. So in those sort of scenarios, suitable disclosures may be warranted here. If there are sufficient internal accruals to fund the acquisition, then it is fine. But if the internal accruals are not sufficient, cash profits are not adequate to support additional new capex, then suitable disclosures might be warranted on this particular point in the financials itself. And this is not restricted only to term loans. Any borrowing of the company which is not used for the specified purpose will warrant disclosure here, whether it is working capital loans or long-term loans. And the next one, a little bit of a cosmetic change. Previously, we used to disclose the current portion of long-term borrowings under other current liabilities. So if you guys remember, we used to talk about current maturities of long-term borrowings, then interest accrued and due, and then interest accrued but not due. A little bit of change has happened where they have said the interest accrued portion remains under other current liabilities, but the current portion of long-term borrowings will now have to come under short-term borrowings. So short-term borrowings will now include not only your cash credit or overdraft or packing credit facilities. The current portion of long-term borrowings will also have to get disclosed as a separate line item within short-term borrowings and not under other current liabilities. And similarly, security deposits that might be given, for example, your rental security deposits or earnest money deposits for certain tenders and all that, those items which previously used to get disclosed under long-term loans and advances, they are now being classified under other non-current assets, not under loans and advances, right? typically loans and advances, there is a character of either getting the money back or receiving some goods or services in return to the advance given. But security deposits typically have a different purpose. They are held as a means of security for the counterparty with whom a transaction is being undertaken, and so I think decision has been taken to move these from long-term loans and advances into other non-current assets. All right. So all your electricity deposits, rental deposits, all of these will now have to go to other non-current assets and not under long-term loans and advances. Typically, companies with HT connections, they have significant amount of electricity deposits, security deposits. Those will all have to now come into other non-current assets. Right? That has nothing to do with borrowings, but it's a related reclassification. So I thought I'll cover it here and close. Where are we now? Okay, 11:40. Shall we take a 10-minute break and join back, guys?
Yes, sir.
Slides done. I think I have another 16, 18 to go.
Yeah, give 10 minutes break.
Case picture is also there. Okay. So 11:42. So 11:55 we'll come back.
Yes, sir.
Okay. Yeah. All right. Satyan, you can probably stop the recording. We can start it again.
Yes.